Hi there guys, and welcome to this week's edition of the Wise Crypto Sunday Special with me, your host, Chris Coney. So today's episode topic is compounding your DeFi returns while earning income. Now this episode is actually based on a question that was submitted to me by someone who was looking at enrolling in my DeFi Masterclass. So I thought, why don't I break this out into a fuller explanation for everyone's benefit. So let's take an up-to-date example based on my direct experience. So in March of 2021, I decided to do a Michael Saylor and take some of the spare cash that I had on the side and put it into crypto. Now Michael Saylor does this with his company Microstrategy, and he does it exclusively with Bitcoin. But I decided I would take a bit more risk and put the cash into Ethereum instead. Now, we can debate whether Ethereum is in fact a higher risk investment than Bitcoin. Let's do that in another episode. Suffice to say, in this instance, I obviously thought so at the time. Now, it turns out that was actually quite a good decision because between it was like the 1st of March 2021 when I did this, and the time I'm recording this video, Bitcoin was only up 3.6%. And in that same time period, Ethereum was up 168%. So on those numbers, my investment is worth about 2.5 times what it was when I started. So right off the bat there, I have a capital gain. I could now sell that investment, subtract the tax-free allowance that we get in the UK, and then pay the capital gains tax on the difference. So let's actually put some real numbers on that so it makes more sense. So in the UK, each year, we're allowed to make £12,300 of capital gains tax-free. Then anything in excess of that incurs capital gains tax of 20%. Now, I'm not an accountant, right? So this is, to the best of my knowledge, all the stuff I'm saying here. So it should not be taken as professional advice, because it isn't. You need to talk to a professional about that. I'm more interested in the framework in general. So far this is all pretty straightforward, right? The whole idea of buying low, selling high, having a tax-free allowance, and then paying the tax on the gain. The next part is where it gets a bit more complex. So I have option one, as I've just laid out there, which is to sell my investment, pay the tax, call it a day. But I personally haven't actually done that yet. Instead, I'm thinking about putting the Ethereum that I'm still holding on deposit with a DeFi platform like Nexo, for example. Now, with Nexo, if I'm willing to lock up the Ethereum for 1 month, well, they'll pay me 8%. And bear in mind, the interest is paid in the asset you deposit. So it's 8% on the Ethereum balance, and has nothing to do with the dollar value of Ethereum. Now, since Nexo is paying me interest, the way I account for this changes completely. So firstly, this new income, well, it's no longer capital gain, it's income. And in the UK, I'd have to account for that income at the cash value at the moment it was paid to me. So Nexo pays interest daily, which that sounds good from an investment perspective, but from a tax and a record keeping perspective, it's a bit of a nightmare. If I deposit, say, 1 Ethereum on Nexo at 8%, right now that would be a $3,820 asset earning 0.02% interest per day. So that works out to 76 cents per day. But it's not 76 cents, it's 0.0002 Ethereum. But the taxman doesn't care about that. As far as they are concerned, I received 76 cents of income on that day, which I now need to account for as income and pay income tax on it. So the only way to stay in sync with the tax accounting would be for me to swap that Ethereum that I earn each day into British pounds. Only then would I have the exact amount of cash to match the income that I need to report to the taxman. What this does mean, though, is that I have completely scuppered the possibility of compound interest, since my Ethereum balance never increases. Now, that might be okay because I've turned my investment into a cash flowing asset, and I still have the possibility of the capital value of the Ethereum I still have increasing. If that happens, and assuming the interest rate remains the same, that income from the investment will also rise. So if it stays at 8%, that 0.0002 Ethereum, that might be worth 75 cents today at Ethereum's market value. But if Ethereum doubles, it's $1.50 a day worth of Ethereum. But the same goes in the opposite direction as well. That 0.0002 Ethereum will also fall in value as the price of Ethereum falls, right? So it works both ways. But taking the interest out completely, right, selling that Ethereum in order to match the tax records, that's arguably the safest approach, since I'm absolutely guaranteed to have enough cash to cover the tax bill when it comes in. I could, however, take more risk and allow the two to go out of sync. So here's what I mean by that. Let's say I swing completely in the other direction, to the other end of the extreme. Let's say I let all of my interest pile up day after day after day and let it increase my Ethereum balance. Not only do I benefit in that scenario from compound interest, earning interest on the interest on the interest, but the capital value of the Ethereum I earn in interest also has the chance to go up. Now that does get a bit complicated from a tax point of view. Because the interest is paid daily, each transaction has to be tracked separately. So I need to record the transaction for the purposes of income tax, but I also need to track the capital value of each interest payment in case I make a capital gain on the Ethereum that I earned as interest. Then that means like I might end up paying both income tax and capital gains tax on the Ethereum interest payment. So with this riskier approach, at the end of the year, when it comes time to pay the tax bill, my account value will be much higher thanks to the compounding effect. Firstly, because of the compound interest, and secondly, because the interest I earned has also gained in value with Ethereum rising. But investment gains are a double-edged sword, right? The more you make, the more you pay in tax. I mean, that bit I don't really mind because it's a fifth of it in the UK, 20% capital gains tax. I'm still making 80% of a larger amount, so that I don't really mind. What I do mind is the absolute nightmare that record keeping becomes. Fortunately, tools like cointracking.info, these have these integrations. So cointracking.info is a web app and it has an integration with Nexo specifically, meaning I could potentially put all this tax calculation on autopilot. So that means I effectively allow the coin tracking software to log into my Nexo account and then pull in all the transaction data. Coin tracking can then do all the various calculations that I just mentioned. And that actually has two benefits. One is that it tells me exactly what my tax liability is. And the other benefit is it'll give me an accurate picture of my returns. Because DeFi interest rates, they fluctuate in real time. Because of that, and because of the use of the coin tracking app, I'll be able to determine what my overall aggregate interest rate is at the end of the year. Now, once those tax calculations are automated, I can then consider employing a third strategy, which is actually the title of this episode. So to compound your returns while earning income would be sort of a three-step process. The first thing would be receiving your interest payments in Ethereum. The second one would be periodically selling half of the accrued interest. And then the third step would be keeping the other half of the accrued interest in your account to allow it to compound. So that is what I will most likely end up doing, because the opportunity for compound interest is just too good to pass up. But that last strategy, the 1, 2, 3, earning compound interest while earning income, that's ultimately how you would do that, compound your returns while simultaneously earning income. So ultimately, in this new world of DeFi, any investment that I make in a crypto asset with the intention of making a capital gain, it should also really be earning me interest while I'm holding it. And the reason I say that is, we work hard enough for our money in the first place. So when it's invested, we need it to work as hard as possible. But that's going to do it for this week's edition of the Wise Crypto Sunday Special. Keep a close eye on your inbox for next week's episode. But until then, it's me, Chris Coney, saying bye for now.